Most people buy stocks based on hope, speculation, and their gut feeling, or also if they get like a hot tip from one of their friends or their family members. Those are not the way to look at buying stocks. When you want to buy a stock, you need to know the value of a stock first. So you cannot just look at the price of a stock and compare it to the price of another stock and determine if it's cheaper or more expensive. You still need to know the underlying value of the company that you're buying. For example, let's say you have a $100 bill and I want to sell you something. So I went to the grocery store and I bought this bag of Mentos for $3.50. Now I come up to you and I want to sell you one piece of Mentos for $100. Would you buy it? Of course not. You look at me crazy because you can get many more Mentos bags than just one piece of Mentos for $100. Of course, you can buy more than 20 or 25 bags. Now, let's say you still have that $100 bill and I want to sell you a MacBook. Now, pretend that this is a new MacBook. It's not, but let's pretend that this one is a new one. So you have $100 and I want to sell you a MacBook for $100. Would you buy it? Of course, because you know the value of a MacBook. You know that a MacBook is worth more than $100. That's the same way that you want to look at stocks. If you don't know the value of the stock that you're buying, why even buy a stock? So the price of a stock itself doesn't tell you that much. You would still need to know what the value is of the underlying company that you're buying. And there are multiple ways to value a stock, but the two most common ways that I use are either the book value or the net income of the company, which can also be the projected net income or a dividend discount model to evaluate a stock. So book value is your total assets minus intangible assets such as brand or goodwill or patents minus total liabilities. Book value tells you what the company is actually worth in tangible assets. So think about if a company bought a building, the building is worth $1 million. If the company bought machinery, machinery might be worth $200,000. Or even if the company bought trucks, those are the tangible assets that investors use in order to value a company. Now, I don't necessarily like the book value way of looking at things because to me, when you value a company based on the book value, those are the tangible assets, what you as an investor will get if the company ever gets sold. Now, the companies that I like to invest in, those aren't companies that are going to be here today and then gone tomorrow. Now, this is a strategy that many investors use. But what I like to do is I like to look at the net income of the company. That gives me a better picture of what the company is worth to me. So with net income, let's say I have a friend who has a business and he comes up to me, he wants to sell me the business. He tells me that I got a great business, it's an e-commerce business, it makes me $1 million every year in net income and I want to sell it to you. After some negotiation, I decide to buy it for $5 million. Now that's pretty cool because I know that this business generates $1 million in net income and I'll have my invested money back in 5 years. And everything after that is just pure profit for me. I can take my originally invested capital and invest it into a different business. That's how I like to look at valuing a stock also. Quick tip, net income and earnings is the same thing. So net income is the total amount of income that the company generated and earnings is the net income per share. So let's say the company generated $1 million in net income and it has 1 million shares outstanding. 1 million divided by 1 million is the earnings per share is $1. Now let's say the company generated $1 million in net income and it only has 500,000 shares outstanding, so shares available to trade on the stock market, then the earnings per share is $2. 1 million divided by 500,000 shares. So I just bought my friend's company for $5 million, right? Because the net income that that company generates is 1 million. Now, when it comes to the stock market, there is a metric that we look at, which is called the PE ratio, the price to earnings ratio. The price to earnings ratio pretty much tells you how much price are you willing to pay for the earnings, also the net income of the company. So for my friend's company, I was willing to pay $5 million for the 1 million in net income it generates. Or another way to look at it, I was willing to pay 5 times the net income of the company. So back to the stock market. At this moment, Coca-Cola is selling close to $50 and it has earnings a little over $2. It's actually at $2.12. So if I take the PE ratio, the price divided by the earnings, the PE ratio right now is 23.33. So if I bought Coke, I'm pretty much saying that I'm willing to pay 23 times the earnings of Coke. Now, what's a good PE ratio then? Now, there are no hard and fast rules. Every investor has their own guidelines when it comes to the PE ratio. Plus, you also have to look at the particular industry that you want to invest in. On average, I like to see a PE ratio of 20 or less, or even 15 or less. That's even better. The PE ratio also gives you a quick snapshot on how long it would take for you to get your invested capital back in the form of earnings. Now, that's just a quick snapshot because, of course, you know, the market is always moving, the price is always changing, earnings and net income on a yearly basis also changes, but it gives you a quick snapshot of, okay, if the PE ratio is 50, it would in essence take you 50 years to get your money back. Now, there are some companies that have extremely high PE ratios, especially growth stocks. So for example, Tesla has a PE ratio over 1000. That pretty much means, looking at the snapshot, that it would take over 1000 years to get your invested capital back. People don't even live that long. But like I said, the stock market is dynamic. It's always moving. It's always changing. So the earnings of a company, especially when you look at the growth companies usually focus on taking any net income that they generate and they put it back into the business in order to expand the business as fast as possible. So yes, a company like Tesla might have a PE ratio that is astronomically high right now, but they can scale it back, look at cutting costs, looking at becoming more profitable, increasing those earnings, and it should potentially bring down the stock share compared to the earnings of the company. And it should potentially bring that PE ratio down a lot more, but only time can tell. So like I said, I like to look at the PE ratio in order to get an indication of how expensive or cheap a company is actually when it's trading on the stock market. Now, there are some additional metrics that I look at. I don't only look at the PE ratio, but that's the first thing that I look at. I look at the PE ratio of the companies that I have on my watch list, and then I delve a little bit more deeper into how much revenue a company can generate, how much total debt a company has, and some additional metrics. There is a video that I created on it, and I'll link to that video right here.